community will be able to bridge the economic gap and begin to pass down generational blessings instead of generational burdens.
Because of this campaign, my kids now understand finance. I find that quite powerful, and that's something that campaign could do for you and your family as well.
Being legacy-minded, having a sense of urgency for the now, and transparency in our community is the key.
It's time that we really take a deeper look on how we can change the world as a whole for every community. Everyone deserves financial education.
We need to learn more about finance. We need to understand some basic principles of how to build wealth.
We want to be able to leave a legacy for our children and our children's children. And how can we do that? By being able to join this platform and learn from this platform and apply it to our family and our lives.
Awesome. Good evening, good evening, good evening, everybody. Wow, we've got a full house. Good morning, good afternoon, good evening, depending on when you guys are going to be watching this, because as you guys know, we are streaming live on social. We're also, this video is being recorded. So thank you everyone for joining us. We do these webinars every Wednesday at 7:30, and it's merely to educate the public. So who am I? My name is Odetta King. I am a senior marketing director here with World Financial Group. We are a force to be reckoned. We are one of the largest financial services in the entire country, as well as Puerto Rico and Canada, right? And our goal is really just to educate the community when it comes to personal matters. As a professor and a financial educator, the concept that we're about to share with you tonight, I can tell you, I know we have attorneys on the line, we have tax people on the line, we have real estate people on the line, and many of us, we did not learn this in school. And this is why we want to make sure that we are sharing this information with our community so that we can help the next generation or even help ourselves. I am also the proud author of 4 personal financial books. First one, If You Ain't Stacking, You're Dropping Your Coins. The goal is always to grow our money. We always heard it's not how much you make, it's how much you keep, right? Second book, This Is Why You're Broke. And a lot of us, like I was just talking to my mom today, and the things that people are doing, that's what's keeping us broke. If we don't know what we don't know. The third book, which is a journal planner, because being in this business for about 7 years, sitting with clients and seeing how you could literally give them the blueprint. But some of us, we still need that hand holding, right? We still need somebody to hold us accountable, check in. And so The Bird of Let's Get Rich Journal Planner was my third book. And now last year, right, as I say, I'm also a professor. I go to different schools here in New York, and I'm always giving back my time with the public school. And one of the teachers pulled me aside and she said, Odetta, well, you're so good with this stuff. Have you ever thought about doing a kid's book? And I said, I thought about it, but it just never happened. I kid you not, I went home that same night, right? And because I have so much content already all over social media, Facebook, YouTube, Snapchat, you name it, my YouTube channel alone has about 700 videos, right? So all I did, one of my students at St. John University, I pulled a couple of videos and I said, hey, Jonna, I want you to, watch these videos and start writing, right? And of course, that was the birth of Playground Millionaire. My gift and my passion is really setting people up to become millionaires, and for sure their kids, because when it comes to money, right, time has a lot to do with it. The more time you and I have, if we know this information, right, we can implement it. And of course, we have more time. So things are going to go much, much, much better versus someone who's like in their 40s or 50s. They have less time. So they're going to be okay too. But with kids, more time, more money, right? So tonight we have a special guest in the house. I met with this individual about, I don't know, correct me if I'm wrong, what, 4 years ago, Imara? 4 years ago. Prior to COVID, we used to be in the office, right? And I don't know how how we got involved, but I know a friend who lived in Canada, because like I said, we're both in the US, Canada, and Puerto Rico. One of my business partners in Canada, he said, Odetta, I have a business partner in the US. I need you to touch base with them. And I said, sure. So I met with a guy named Rohan. Let me see if he's on, right? And Rohan, part of his field training or part of his training, he introduced me to Imara. Now, I got to say this, Imara probably don't know this, right? This is the first time I'm saying this. Imara had a chip on her shoulder because, of course, she's a tax professional. She knows it all, right? So she came into the office and she's like, girl, I know everything about taxes. Okay, there's nothing you can teach me. I'm like, okay, we're going to see about that, right? And Donna, who is an attorney, she's on. This was at our office, 2174 Nostrand Avenue. So Imara came over there, and guys, this business, when people who really know and see this stuff, they don't think about it. As a tax professional, you're going to hear from Imara today. As a tax professional, she sat in my office. She asked a jillion questions. We went over everything, and she signed up on the spot, right? She's a tax professional, and she did not know this information. She signed up on the spot. Not only she got better strategies for herself, and at that time she only had one kid. Now she got two, right? She signed up on the spot. She got an account for herself. She got an account for her daughter. And of course, she immediately studied, got the license, and was able to also add another source of income in her line of tax planning and helping her clients. So we are super, super humble and blessed to have Ms. Imara Hercules, who is a licensed tax professional. She'll give you her bio. She'll talk about a little herself, and she'll go ahead and share this information that we have with you tonight. So take it away, Imara.
Alrighty, thank you, Odetta, for that lovely introduction. I did have a chip on my shoulder when I did meet you 4 years ago. It has come off now, so thank you for that. And I just want to say thank you to everyone who is joining in with us tonight, because you could have been doing anything else, but you are taking the time out of your evening to be here with us. Odetta and I do have a passion for educating our community, especially because these are the tools, resources, and knowledge, like she mentioned, none of us were taught in school, that people do not willfully give us. So while we are committed to educating any and everyone, our passion definitely lies within our community. And just so that you guys who do not know me know a little bit about myself, I do have a tax business. I am a registered tax professional with the IRS. I've been doing taxes for about 15 years now. I have over 400 clients. And I added getting licensed in insurance and health and different avenues so that I could provide additional services to my clients to help them. So we became a one-stop shop to not only do their taxes, but to show them what they could potentially do with their tax refunds, to show them how they could save additional money in the interim also. So I'm going to share my screen, and we're going to jump into this a little bit. I hope everyone's hearing me okay and seeing my screen. So, is your money working for you? Now, and I'm sure Odetta can talk about money topics, financial literacy all day, every day until we're blue in the face, right? Because we just enjoy talking about it. So as we go through the presentation, I want you to keep in mind, what about money is important to you, right? I mean, if you have a pen and paper, maybe you want to jot that question down. What about money is important to you? Is it, of course, being able to pay your bills? Is it, saving for retirement? Is it planning for, your children's college, future expenses? Or maybe it's investing. Maybe you're an entrepreneur, you're looking to start a business, you have a business. So what about money is important to you? And why did you join us today? Maybe you have questions. The topic or the term financial literacy is thrown around a lot, right? It's all over social media, it's everywhere. But what does financial literacy mean? Maybe that's why you joined us. Or maybe you're talking about generational wealth. What is that? So what we're going to talk about briefly tonight is one, learning to save and grow your money. If you have children, grandchildren, nieces or nephews, or friends who may have children, savings for their children to provide a better life for them, have a better starting point, right? Protecting your income. If you're looking to retire, and you want to make sure that you have enough income to live out and enjoy your retirement years, retiring comfortably, if you want to travel, live your best life, protecting your family's income, if you have assets, trust, different things of that nature. And then maybe you're an entrepreneur. So we want to protect your business. You want to make sure that you have enough capital to run and fund your business, and then potentially even transfer your business on to maybe a family member. So budgeting and saving. And this is like one of my favorite slides. I feel like every time I mention the word budget to people, they either break out in a cold sweat, they get heart palpitations. Like nobody likes to hear the word budget for some reason, right? You feel restrictive. I don't know, but everyone hates the word budget. So what we like to do is in this industry is talk about financial strategy. So we replace the word budget with putting in place a financial strategy. And what is a financial strategy? It's pretty much knowing how much income you have coming in, whether it's on a daily, weekly, or monthly basis, and then minusing all your expenses. So key expenses to keep in mind when you're putting together your own financial strategy would be, of course, your rent or your mortgage, your cable, internet, gas, all your utilities, your cell phone. If you have health insurance that you pay for, if you already have life insurance that you pay for, these are all expenses that you want to jot down and keep in mind. And now, I know most of us probably don't even have cable anymore, so we definitely have a lot of subscriptions. Netflix, Hulu, Disney. I'm an Amazon person. I'm an Amazon Prime person, always shopping on Amazon Prime. But what about, Paramount, Peacock, Tubi? There's so many subscriptions, but that's also an expense because I'm sure you have it coming out of your accounts, whether it's on a monthly basis or an annual basis. So we definitely want to account for that because a lot of people forget how many things that they have coming out of their account automatically. Even your gym membership. How many people have started going to the gym at the beginning of the year and stopped already? We're in June, so I'm sure some of you have probably stopped. I know I did. And that subscription is still coming out of your bank account, right? So transportation as well, whether you take Ubers and Lyfts all the time, whether you're living in the city and you need to buy a Metro card, gas, tolls, your car note, your car insurance, all of those are important to make sure that you detail and identify. Debts, student loans. There are a lot of student loan forgiveness programs going around right now, but if you don't qualify for it or you're not eligible, you need to account for your student loans, credit cards, and other personal loans that you may have. And then miscellaneous, whether you like to get your hair done, your nails done, your barber trips, recreational activities, if you like to travel, things like that, you definitely want to account for. And then what type of income are you looking at, right? I'm not just talking about if you have a W-2 and you work for a company. What if you are an entrepreneur, right? And you're a bartender, maybe you are a hairdresser, maybe you have a restaurant, that is your income. And what you pay yourself, whether it's on a weekly, monthly basis, that's what you need to account for. Then your savings. Do you have a savings account? Your bank accounts, your money market accounts, even online bank accounts. You want to definitely make sure that you account for what you have in there. Retirement accounts. I've seen this time and time again. You may have, 2, 3, 4 jobs maybe over your professional career. How many 401ks do you have with all of those employers, right? So you want to make sure that you know where your money is and where it's being invested, even if you're not directly dealing with it on a daily basis. And then life insurance. If you already have a term, whole, or index policy and you pay for that, you want to make sure that you account for that. Now, when we do a financial strategy, this is pretty much what you get. And if you are interested in doing a financial strategy, you can get with myself, you can reach out to Odetta or whoever invited you on tonight so that we can help you put together a proper financial strategy. Because if you don't know how much discretionary income you have, how do you know what you're able to afford? How do you know what you're able to invest? How do you know what you're able to save, right? So this is just a brief synopsis of what a proper financial strategy would look like. And some things to keep in mind when creating a financial strategy. I tend to go over these 4 key points with my clients. So 1, you want to envision the plan, which is creating your detailed financial analysis, like what we just went through, jotting down everything under the sun that you spend money on and where your money is coming from. And then determine what your goals are. What are you trying to gain from putting together your financial strategy? Again, are you trying to save for retirement? Are you just wanting to travel? Maybe you're looking to purchase a home or a vehicle. Not just having the details of a financial strategy are enough, but I feel that having goals, something to work towards, definitely help propel you and make a difference when putting together your financial strategy. And then to execute it, now you got to put the plan into action. Once you jot down all of your numbers and figure out what you have saved, maybe, you might need to look for an additional source of income because what you have coming in right now is not helping you take care of all of your expenses. Or maybe you do have enough coming in right now, so you have enough discretionary income where you now can invest it in something else. You can invest it or save it in a tool or resource to help you gain more assets. 3, engage and commit. And this is the hardest one that I feel a lot of my clients and just people overall, commit and consistency. So it's easy to at the beginning of the year, okay, I'm going to put in together a budget. I'm going to put together my financial strategy. These are my goals. This is what I want to do. But, 2-3 months later, life happens, things get in the way, emergencies come up, or you just get tired of doing it, and then you forget about what you started. So remaining consistent and remaining accountable to yourself is very important. And then, of course, you evaluate, you review it, making sure that what you're doing is actually meeting your needs and meeting your goals. And then you can decide, whether to change it or put other plans in place. So this topic I love. 3 rules of money. First rule of money, compound interest. Now, this is something that's so key in understanding how money works that is definitely not taught in schools. Even in college, they're not really talking about compounding interest unless you get really deep into accounting, forensic accounting, and things like that. They don't even teach this in taxation. So what is the rule of 72? This is going to show you how to double your money, how to make your money grow, accumulation, right? So you take the number 72 and you divide that by the rate of a return of whatever account your money is currently sitting in. So if you currently have a bank account, let's say for instance, and it says, okay, 4% interest on this account. You take the number 72, you divide it by 4, and that tells you that it's going to take 18 years for whatever money you have in that account to double. So if today you have $10,000 in an account that's earning 4% interest, in 18 years, you'll have 20,000. And in 36 years, you'll have 40,000, right? 18 years is a lot of time just to wait to make your money double. I'm just saying. So let's say, for instance, you have an account earning 8% interest now. 72 divided by 8 will give you 9. So now it's taking you 9 years for your money to double, which is less time, which is great. So that means your money is going to double faster for you. Your money is going to work faster for you. So today, if you have 10,000, instead of waiting 18 years to get 20, now in 9 years, you'll have 20,000. And in 18 years, you'll have 40. And the same thing, 17 divided by 12. If you have an account, if you have an IUL, an index account that's earning 12% interest, now it's taking only 6 years for your money to double. Again, your money is going to work faster for you, which means you're going to have more discretionary income, you're going to have more assets at your disposal. And the difference between a 4% interest rate and a 12% interest rate is literally $600,000. Now, 40,000 is nice, but 640,000 definitely looks a lot more appealing to me and definitely to most of my clients. So let's talk about taxes, because they say the only thing certain in life, right, is death and taxes. We can't get away from that as much as we try, but there are definitely loopholes into taxes and what you can do. So Tax Now accounts. Many of us on here have a Tax Now account. We have a checking, we have a savings, maybe you own a CD account, or you have some stock options. I have a lot of clients who've been playing around with Robinhood and Acorn accounts and things like that. Now, the reason why it's called Tax Now is because normally at the end of the year, whatever interest that account has generated, you're going to have to pay taxes on, right? So if I have $100 in an account and I earn $10 of interest, I'm going to have to pay taxes on that $10 that I earned, which is pretty much cutting that $10 in half. So how much did I really earn? Probably only $5. Tax later accounts now are most people's retirement accounts. So you may have a 401k or 403b with your current employer. If you're in the military, a 457, teachers, you may have these accounts. Some of you may have an annuity or a pension. Why are they taxed later? Because while you're working and you're going throughout your life, money is being taken out of your paycheck, right, to fund these accounts. Your employer is doing that for you normally in conjunction with a company. So what happens? When you're ready to retire, this money that you've worked 30, 40, 50 years for to save so hard and so long, when you're ready to retire and take that money out, now you have to pay taxes on it, right? So you could literally have an account with $500,000 in it, and when you're ready to start taking out distributions from that account, you're possibly and potentially are going to be taxed half of that money. Tax-free accounts. We love tax-free. Sounds better than tax now and tax later. Who doesn't like anything with the word free attached to it, right? So Roth IRA accounts, those are great. Those are tax-free accounts. You have 529 college savings accounts. Those are tax-free, but some of them are invested in the market where you can lose money. And also if you don't use them for certain accredited funds, education, you will lose money when you take those out. We also like to talk about cash value life insurance. That's also a tax-free platform where you can save money into, so that when you are looking to take money out of it, whether again, it's for retirement, it's for school, it's for your business, the money that you withdraw from it will be tax-free. And how your money grows. This is very important because you need to know what vehicle your money is in and how that is going to affect how much you're going to earn. Is your money actually going to grow or is it going to be stagnant, right? So most accounts checking, savings accounts are fixed. Right now, I know in the US, most regular checking and savings accounts might earn 0% interest or 0.001% interest, right? You're not really earning anything. It's just sitting there. So what's good about fixed investment options is that your money is safe, right? There's no market upturn, there's no market downside. Everything is there. You know your money is guaranteed. But the downside with the fixed investments is that you have no growth. You're not really seeing your money work for you. Variable accounts, which most of your 401ks, 403bs, IRAs, and pensions are in, are variable. The reason why they're called variable is because they are invested in the stock market. So if you know anything about the stock market can go up and the stock market can go down. Now, when the stock market is going up, everyone is happy, right? You're making money, your money is growing, things are looking good. But when the stock market goes down, you can potentially lose half of what you even have in your account, depending on how low the market goes. And that was definitely evident to a lot of people during COVID. A lot of people had money saved in their 401ks, their pensions, and unfortunately, the stock market fell miserably for almost 2 years straight. And I know people who have lost over 140,000 in their retirement accounts that they've worked for 40 years, and they would not recoup that money because the stock market is not going to bounce back in time for them to recuperate all of that money that they lost. So variable accounts are great because you have growth, but variable accounts are horrible because there are no safety. So ask yourself, do you have the time, the energy, the mental capacity to deal with the roller coaster of the stock market and a variable account? Index accounts, I like to say, are a hybrid between fixed and variable. You get the benefit of safety and growth with index accounts. So most index accounts are in the S&P 500, which has a growth rate normally of up to 13-15% over year. So when the S&P 500 and other indexes go up, you earn interest, you earn dividends, your funds go up too. If the market falls, indexes usually have a floor rate, meaning they have a minimum. So, and the minimum is usually at 0, right? So if the stock market falls down, you don't lose anything because you're at 0. You're safe. You have a safety net. And when the market goes back up, you get to reap the benefits of the growth. Excuse me. So again, index, you have safety and growth. Variable, there's no safety, but you can have growth. And fixed, you have safety and no growth. So here's a great way to kind of look at everything that we just talked about when it comes towards your different retirement plans and index funds, right? You might have a 401k or 403b. It's great because it's pre-tax dollars. Your employers are normally contributing it for you. You don't have to worry about it. It's done already for you. You have tax deferred growth, so your money is going up. But then again, you have stock market risk, and then you have a lot of concessions too. When you take out that funds, you have to wait until you're 59 and a half to take out your money. If you don't wait to that age, you'll get an early penalty. You have to use your money by the time you're 72. And then it gives you no other guarantees. There's no protection. There's no life insurance. There's nothing that helps you if you were to get ill or protect your resources or your benefits, right? Or help your family in the interim. Now with Index Universal Life accounts, you get the same after-tax dollars. You're putting your own money into this. You're funding it. You're managing it. There's no loss. You have a guaranteed no loss because I told you they have that floor rate of 0. You get tax-free withdrawals. You don't have to wait until 59 and a half to take out your money. You can take out your money whenever you want. You can be any age and have an Index Universal Life account. I have one for both of my children. My son is 2, my daughter is 6. They both have Universal Life accounts. I have one for myself. And what do you get with that? You get not only saving your money, getting growth, getting protection from market risks, right? In case there's another pandemic or natural disaster, but you're also getting life insurance coverage. God forbid something happens to you, your family, your friends, your loved ones would have some discretionary funds left over. You can get long-term care. You can get critical and terminal illness care. If you fall sick and you are the provider, you are an entrepreneur, you are the breadwinner for your family, for your friends, for your loved ones, how are they going to survive, or how are they going to be supported if you are ill? Who are going to pay your doctor bills when you are ill? You can get that coverage and that safeguard with a universal index account. And I just want to show you one more here with the 529 college savings plans. Odetta goes to a lot of schools and, talks to teachers, parents. I do the same thing. I host workshops at schools, and a lot of parents come up to me and want to talk about a 529 college savings plan, which is a great way to take advantage and save for a child's future. The unfortunate part about 529 savings plans, you're in control. You have to pick where the money is going to, right? What funds. If you have no knowledge of stocks, investments, how are you going to make a wise and sound decision? They do not provide guidance on that for you. Most of them are fixed and variable interest options. So again, fixed, you'll have safety, but you won't have much growth. Most times they're usually at 3 to 4% in a growth rate. They are in a variable investment. They're in the stock market. So you'll have highs and you will definitely have lows. It could only be used for college or certain accredited functions, right? And if you don't meet those guidelines, then the money will be taxed completely. Now, again, with a universal index account, you can still get advantages. You can still save for school for a child or a loved one. You can use the money for anything. If they decide not to go to college, maybe they want to become an entrepreneur. Now they have capital to start up their own business. Maybe they want to buy a home. Now they have that funds to use for a down payment. Or maybe they'll have enough in their account that they can buy a house outright and not have to have a loan, not have to have a mortgage, not have to be in debt. There are no additional taxes, fees, or charges with a universal account as opposed to these other accounts. And I know, Odetta, you wanted to chime in a little bit to talk about the tax codes that help with this.
Yes, I do. Guys, wasn't that amazing? Put one thing in the chat that you've already learned that you did not know prior, right? Put something in the chat. Let's see what you guys have. As I mentioned earlier, because of my affiliation and going to different schools, I came up with this book, Playground Millionaires, because I heard a resounding amount of, like, every school that I've gone to, every parent, even the teachers, even the principal, they're all telling me they're so happy to say, oh my God, I got a 529, so I'm doing good with that. And I'm like, hold up. I'm so happy that you're saving, but you're using the wrong vehicle, right? So Playground Millionaire is to show you how to set your kids up to be millionaire beyond college. That's another thing I see. Most of us, if we are saving for our kids, the buck stops with college. Like, it's only college. Like, we save for college and then that's it. You're on your own. Well, Playground Millionaire is setting you up for lifetime and not just college time. And speaking of the taxes, right, this is a page in the book. Let me see if I can make it bigger. All right. When it comes to the taxes, the reason why we love, and again, you can save money, or many people are, they might be saving, they might be investing. But we also heard it's not how much you make, it's how much you keep. So if we're doing the right thing to grow this money, are we thinking about the tax consequences? Are we thinking about when we're ready to access this money, how much you get to keep? Because if you're going to grow, and you amass wealth to 1 million or 2 million, no one is really talking about, now that we have this 1 million or 2 million, how do we keep all of it, right? How do we keep all of it and not have to pay a penny in taxes? 25 benefits of an IUL. And again, this is my phone book. So if you want to get a copy, make sure you get in touch with us. And I'm just going to read the first 4, right? These are IRS codes. This is an insurance contract. This is not something that I made up or Imara made up or any CPA made up. This is in the IRS code, right? If you know, you know. So the death benefit is tax-free, IRS code 101A. You can Google these codes for yourself. When you and I save money in a 529 or an IRA, when we die, there's no death benefit, right? But also the money in those accounts, when you and I die, we got to pay tax on the gain in those accounts. But guess what? With an IUL, Index Universal Life cash value policy, my gains, Imara gains, our kids' gains, their kids, right? Because we're putting things in place for generation. All of the gains is tax-free, and it's IRS code 72E, right? Now, we're saving money in these accounts, and you're also going to want to borrow money, right? Some of you have your 401k at your job, you have your IRA if you're self-employed, or maybe you just have an IRA, or maybe you have a 529, or whatever you have. You're going to want to take money from those accounts, right? And you already know this. When you take money from those accounts, if you're under age 59 and a half, well, you know there's a 10% penalty, right? Can we all agree that? Right? There's a 10% penalty for accessing your money. On top of it, now you have to pay tax on the money. Now, if you're saving that same money in an IUL, cash value life insurance, IRS code 7702, it is tax-free loan. So if I want to pull out 100,000 cash value from my IUL, it's 100% tax-free because of IRS code 7702. Now, you may be saving in other types of vehicle. You may be investing in other types of vehicle. You grow all this money. Now you're ready to retire. My question come back to you again. How much do you get to keep for your retirement? My IUL, 100% is tax-free retirement income. Guys, understand that tax-free money means more money. If you got $1 million and wherever it's sitting, you have to pay taxes on it, you don't have $1 million. On top of it, you don't even know how much you're going to have to pay in taxes in the future. You have no control. IUL, IRS code 7702, IRS code 72E, IRS code 101A, it's all tax-free. So who gets to keep more money?
I do.
Again, it's not about saving money, it's saving money smart. And this is where there's a big void in our community. Most people are not taught, right? We're not taught to invest or save or grow your money in a cash value life insurance. Now, I know some of you are probably saying, well, Odetta, I already got a life insurance. Well, if you do, that's great. Mm-hmm. But then again, which type do you have, right? So again, This is why we do these webinars, and I'm going to turn it back to Imara to continue, but I just wanted to chime in there.
Yeah, and I would add to that, just so that you guys know, I recently had a new client that was referred to me. And, you know, a lot of people come to this country from other places and get a great job. And, you know, they're working, they're saving in their employer's 401k and different retirement plans because that's what they're told that's the right thing to do. And she wanted to take out money out of her 401k to build a home back in her country. So when she called me, unfortunately, she had already did the transaction, right? And I had to educate her now that she's not 59 and a half, so she's going to have to pay that 10% additional penalty, but then also pay taxes on that lump sum that she took out, which would be probably about 35%. So now she's paying 45% in taxes of the money that she took out to purchase a home for her family back in her country. But she did not know that. And she asked me why nobody ever told her this, or why do the companies, when she was making the transaction, not explain it to her? And I'm like, because that's not their job. You know, they're just here to shuffle the paperwork, click the buttons. You are the one who has to make the choice, to make the decision. But how can you make the right choice and the right decision if you do not have all of the information? And this is why Odetta and I do what we do, right? Okay, so I just had to give that little story there. So let me go back to this slide over here in the presentation. Good. So growth. Most index universal accounts have a growth rate of up to 13%. And if you can remember, I know I've been throwing a lot of numbers and a lot of figures around during this presentation. Most bank accounts, you're barely earning 1% interest. If you have a money market account or an online bank account, you might get lucky and earn 4% interest because interest rates have been going back up, but you're not getting 13%. And most times in your 401ks and in your IRAs, you're not getting 13% return on average over time, right? Then you have a safety. You can have a zero cap or you can have a safety of 0.75%. So at least you know that you're either not losing money at all or you're still getting something, and something is better than nothing. Then your tax-free benefits, right? Especially when you take money out, no matter what age, it's your money that you worked hard for. You don't want to pay additional taxes on it that you don't have to. And then you want to be able to access your money whenever you need it, whether it's a family emergency, whether you want to buy a home, whether you want to go to school, whether you want to start a business. It's yours. You should be able to access it without any penalties or additional taxes and fees. And then why not get added protection, added benefits, right? Life insurance coverage for your loved ones, chronic illness or terminal illness if you become sick. People don't understand how costly it is to pay for a nursing home, how costly it is to pay for a home health aide or rehabilitation center and things like that. And yes, Medicaid, Medicare, your health insurance may cover partial fees, but a lot of times you end up coming out of pocket 20 to 40% for those expenses on your own. So here's some, I guess, more numbers. You know, I'm a tax person, I like numbers, right? So please forgive me. But if you were to have an account, an index account right now, and it's earning you 8%, right? If you contributed $200 a month, that's literally $50 a week. I know people who spend more than $50 a week on gas, on eating out, on Ubers and Lyfts and everything like that. But if you can save $50 a week, In 10 years, you can have $36,000 just sitting in your account waiting for you for whatever you need it to. In 20 years, you can have over 100 grand. And don't take these numbers lightly because most Americans do not have access to this type of money. Most Americans do not have over 150,000 saved for their retirement needs. So these numbers are not to be taken lightly. So here I want to show you, and I know this might be a little bit small on your screen, so please bear with me. If you had a child, a grandchild, or anyone who has children and they want to save for their kids, you may get birthday money, Christmas money. I don't know. My family, we even give Easter money. I don't know. It's a thing. But whatever money my kids get, I put it into their index policies. So this is an example of a child who's 1 year old and their family is saving $300 a month for the child. So if you look on the right side of your screen, the child decides at age 19 that they want to take out $20,000. Now, I don't know why they're taking out $20,000. Could be for a car, could be to pay for school, or it could be because they want to start a podcast now. Who knows, right? But they took out $20,000. But that's because they had over $85,000 in cash in the policy to take out from. And then 20, they took out another 20,000. 21, another 22, another 20,000. But as you can see, as they're taking it out, the cash value doesn't go down that much because whatever was still left inside of their policy was still earning interest. That's the beauty of compound interest. Although you're taking money out, whatever is left in there is still working for you. Now we have someone who's a little bit more mature, right? How some of us are in her 30s. She doesn't have a retirement plan with her job. Maybe she's an entrepreneur and she's saving $600 a month because she knows that she doesn't have anything put aside. When she decides to retire, let's say age 71, she decides to take out $68,000 a year. That's a pretty decent amount, a pretty decent salary to live off of in retirement, $68,000. And she does that for over 12 years and she's living comfortably. And what happens? Again, there's still cash value left in her policy and there's still a death benefit left for her beneficiaries over $1 million that she can give to them, God forbid she passes away. So she was able to live comfortably during retirement while still leaving a safety net for her beneficiaries. Now, who wouldn't want that? Being able to be comfortable during retirement and still making sure that your loved ones will still be taken care of when you're no longer here. And this one, we have a lady who's a little bit more seasoned, right? We like seasoning over here. She's over 50 and she's saving $2,000 a month. And the reason why she's saving so much more is because she's starting a little bit later in life. And honestly, to get the full benefit, to get the full advantage, and to make the money work for her, she needed to invest a little bit more, right? So at 50, she saved for 20 years. She had over $687,000 in her account. And she decided to take out $52,000 every year to live comfortably during retirement and was still able to have money and a benefit left over for her beneficiaries when she's no longer here. And if you could see these little characters up here where it says riders, T1, CRN, CRT, that's telling me that she has terminal illness coverage, she has chronic illness coverage, so that if she became ill, she would be able to take money out of here because the policy will pay for her medical care when she elects so to cover those medical fees and charges so that she is comfortable while still maintaining funds in her policy for her beneficiaries. So there's a lot of ways to work an index policy regardless of your age and regardless of your work status and regardless of your goals. What are your financial goals? So I just want to leave this with you guys today. Start saving today, start planning today. Forget about yesterday, forget about what you didn't know, because today is a new day. Hopefully you have learned a lot from me and Odetta, and begin your journey today. That's my
Wow.
time.
Thank you, guys. Okay, so I know you guys. Has anybody put something in the chat that stood out to you? Right? Something that you learned tonight, something that stood out to you. Write it in
I
the
saw a
chat.
few comments in the chat. Anything throughout it? Some people have been commenting while we're here. We still have a few minutes, so bear with us. We just want to make sure if there's any questions or anything, we can get to everyone.
Yes, we can go through the chats. If you have a question, you can drop it. But guys, one of the things that we see is, when we sit with clients, they're saving. We see that. But what we would like to see is the correct vehicle they're using to get to their goal. What we would like to see is almost none of us, I don't know, maybe Imari, you can chime in. Have you seen anyone put a plan in place for any chronic, critical, terminal? Nobody's thinking about these things. We think we're going to be young forever. We're going to be healthy forever. We're just going to die suddenly or die one day healthy with nothing wrong, right? So
only my clients who are, in the police or corrections division, they would have like some kind of accidental kind of policy, but nothing for if you were to get really disabled, terminal illness, cancer, things like that. I mean, this is New York. You could get hit by a bus, like you just don't know. So I have honestly never come across a client in all these years that has something in place like that.
Same with me. Never. And guys, also, if you are working with the job, here's another thing that we hear a lot. Oh, that I'm good because I have a job, something, right? Like I have a job, whatever. But guys, the same way how they give it to you, they can take it away from you. Miss Barbara Johnson is not on. She is an educator for 30 years in St. Louis. Okay. On the 2 years after she retired, after working for the education system for 30 years, her second year in retirement, they decided to pull the plug on some of their benefits. Yeah. So I say this to you, whatever your job gives to you, your job can also take it away from you, right? If business is not doing good and they got to cut costs, they're going to do whatever they got to do to keep the lights on and the doors open. So if they got to cut whatever, they will be cutting it. It's not personal, it's business. So I always tell my clients, if you have something with your job, that's great, but let's get you something better and let's get something of your own, right? Where you would be the one who can pull the plug and not be at the mercy of someone else because it's your job that offer you this benefit.
I've also seen, Odetta, like a lot of employers who offer a 401k or 403b, they change carriers, they change companies, and that's not for your benefit. That's for their benefit. So the fees that they're paying to cover your policies and the plans and the packages, they're looking for shortcuts. They're looking for lower fees. Or if you have a pension, they're changing the pension fund. You may get notices in the mail, oh, your pension fund has changed to this or it's been updated to that. It's because the employers are looking for ways to save money for them, not for you.
Wow, those are some good points. So again, we know that some of us are saving money, some are not. We got to start saving, but the conversation is where. We just showed you a strategy where your money is growing, your money is tax-free, You don't have to worry about losing or what the stock market is doing or what the economy is doing. There's none of that. I don't watch TV because I really don't care which S&P is up or down, right? My money is always up in my IUL, right? If I want to go buy another property next year, well, I don't have to worry, well, oh, I'm under 59.5. If I take money from this IRA or 401k or whatever, I'm going to get hit with a whopping 10% penalty. Then I got to pay the taxes on it at the end of the year. None of that matters, right? And then fast forward, now I'm 65, 70, 80, 90, whatever age. If I got to go in a nursing home, it's going to be a fab nursing home because guess what? My money is going before me and not me at the mercy of Medicare or Medicaid or whatever they're going to decide to give me when I'm 70, right? So guys, you put yourself in the driver's seat, help to have control of your future. And we are always looking for people like ourselves who want to teach this information to our community, who want to educate the public, because we know that financial education is something that almost nobody knows, right? Most people have never been educated on these concepts. I mean, my dean doesn't even know this stuff, right? And it's crazy. Like, I went to my dentist yesterday and I was talking to him and he's like, Odetta, all I know to do is what I'm doing. And when it comes to the money, that's your part, okay? But this is not something that we learn in school. So we're not expecting people to know about it. This is why we do these webinars. So we're always looking for people like ourselves to share this information with your community. We know we cannot reach everyone, but there's a lot of people that have access or who know, I mean, my neighbors, right? People at my school, people at my church, people at my gym. Now, to do what we do, you do need a license, right? All of us, we are licensed financial professionals. And once you are registered with the state, you've gotten your state license credential, you go through the background check and all what it takes to schedule and get your exam done. Once you have this license, I tell people this license is better than a PhD, okay? And take it from a professor. This license is better than a PhD. I could never go to my dean and tell my dean, you know what, Caroline, I want to make $1 million this year. She's going to be like, yo, that me too, okay? But over here, there's no limit. There's no limit on how much you and I can make. And what we do is we help people to save money. There's so many people already out there helping us to spend it. We're coming in saying, hey, let me show you how to save your money. Let me show you how to grow your money. Let me show you how to protect your money. This is what we're doing. We're not trying to tell you to spend. We want you to save your money. And when you save your money, I just unmuted myself. And when you save your money in the right vehicle, you put yourself in a position to control your future, right? So when someone sees this information, it could go two ways. You could say, Daddy, you know what, this sounds great. I had no idea. I have a 529, I have a 401k, I have an IRA. I got money in the bank. I got money under the mattress. You know, I have a life insurance. But now that I know this stuff, I want to get a free consultation. I want to get a free financial review to see what's going on, to see where I can make some tweaks to bulletproof my finance. Guys, sidetrack. We spoke with an attorney. Okay. We spoke with an attorney. I've been speaking this today was my second appointment with him. I spoke with him last week. We had a follow-up. His wife, cancer. They're still here. They've been battling it. Money is going through. Money's just going in thin air, right? Medication, the treatment, everything. They sold the house. They got a nice, decent, you know, big chunk of money. The money's sitting in the bank, earning whatever's earning, which you guys all know, nothing, right? Less than 1%. So someone, by the way of who I help, referred me to this person. And by the way, he's an attorney, okay? Much older than me. He does what he does, very well established. When I shared this information with him, he said, Odetta, how come my financial advisor never told me about this strategy? How come my financial advisor never told me about strategies like these, right? Had I had these things in place, I wouldn't be spending all this money right now, because now the living benefit, his wife got diagnosed with cancer, the living benefit, the long-term care would have been paying him a check, as opposed to they're coming out of pocket to pay for that care, right? And another thing that they're very concerned about is the money that they have going to last them to the end of time? So it's not just about saving, guys. There's so many other layers that when we sit with our client, we want to make sure we put things in place, not just for a lunchtime, but for a lifetime. True transparency, I had a conversation with my mom today, and I said, Mom, if I pass away today, you guys' life are forever going to be changed. And the longer I live, my nieces and nephews' life, their kids are also forever going to be changed. We put strategies in place, not just for us, but the strategies are so solid that by default, it's going to impact and protect and be there also for the next generation. So this is something that everybody needs to at least know about. And then they can decide what they want to do. So we're looking for people like ourselves who want to teach this information to our community. Maybe you already established as a business owner. Imaris established as a business owner, but guess what? She saw the need and decided, you know what? I'm going to get this license and I'm going to still continue doing taxes, but now I can add more value to my clients by giving them this information. And because I have the license, I could help them implement these strategies as opposed to just telling them about it. So when you come on board and you have your credentials, again, we educate, and we're going to put a plan in place to help you grow and save and protect your money. Let's say someone is saving $500 a month. They might already be saving that money, but we're in a 401k, in an IRA, in a CD, in the bank, under the mattress. No concept of taxes, no concept of Rule of 72. No concept of managing their risk, how much the money is going to grow, how much they're going to lose. None of that. All they know, they're saving. So they don't have all the information to make the best decision on their finances. Here, when you sit with us, the same $500 that you're probably putting somewhere else, we educate you. And then we said, you know what, let's put that same $500 that you were already saving, let's put it over here instead and get all of these bells and whistles. You're leveraging your money, right? So when you start with us, you're a trainee. Your first 30 days, you're a rookie. You're straight out the gate. You don't know anything. You're in training, right? So $500 per month times 12 months is $600, right? $6,000. As a training associate, 30% of this $6,000 is $1,800. That's how much you make per account. If this person is saving $500 and if you know what you're doing when you sit with this client, but you're in training, you don't know what you're doing. You can move up to an associate, same client saving $500. Now you're at a 45% contract. So you're making $2,700, same work. You're just more skilled, you know more. You're independent. You want to build an agency like us? You could move up to a junior broker at 62%, same work. Somebody saving $500. Now you're making $3,720. Or an SMD like myself, 80% contract, same work. Now I get paid $4,800. Guys, how much do you take? How long do you have to work at your job to make these kind of numbers? Let's just start with a training associate, entry level. Right? You don't have to type it, but you know. How much time and hours do we have to put in to make $1,800 as a training associate, which is an entry level for us? Entry level, right? Here, we make this money in about 2 hours. 2 hours, right? Even if it goes to 3, I'm still okay with giving 3 hours of my time from the comfort of my home on Zoom, helping any clients across the country. entry level. Now, when you move up and you're a senior marketing director, you own your agency. And you, with 5 other licensed agents, right, as an SMD, with 5 other licensed agents, let's say they're all saving, helping a family save $1,000 in the whole month, which is nothing. That's 4 kids IUL saving $250 a piece, or that's 2 working people saving $500 a piece, right? Now you, as an SMD, you make $10,000 a month. Your 5 agents that are also working the business because you brought them on board, you train them, you help them go in, they're on their way making money, but because you brought them on board, you're overriding $21,000. You're not taking money away from them. The company is paying you and I this. So your total cash flow per month, $31,000. Guys, who do you know is making $31,000 per month? Or let's say even $20,000 per month. And this is a business. And because we're in the financial business, we know the ins and outs. So this $31,000, if you were working at your JOB, this $31,000 is not $31,000 because you got to pay tax on this and you have nothing to write off. But this is a business. So this $31,000, most of it is going to be us. We get to keep that money in our pocket because we teach this information. We know what to do. And it's a business that has legally tax write-off. And we know where to move and put the money. So we get to keep more of it in our pocket, right? So in closing, life is all about choices. You could say, okay, Odetta, this sounds great. You could take the next step to find out how can you become a business partner in the financial services. Or you could say, you know what, this sounds great. I don't think I'm cut out to do the business, but I want to be a client. I need help with my finance. Or you could do both like us. Some people start right off the gate as a business partner. Some people come on board as a client. I came on as a client first, right? I came on as a client first because back then, 7 years ago, I had 100,000 saved in the bank and I thought I was good. I'm like, I'm good. But guess what? I was not good because when I learned this information, I realized 100,000 is nothing. Inflation is going to eat that up. Right? So I came on as a client to get help with my own finance. And the more I got on these trainings, back then we used to drive and go to the office. Today, it's so much more easier for you guys. This business has gotten so much easier. Back then we used to drive to go to an office to get this training. And it just took me maybe like 3 or 4 trainings. And when I saw the information, I said, I know my community does not know this information. I know my faculty doesn't know this information. I know my student doesn't even know this information. How could I be a teacher, learn this stuff and not teach it? So I decided to get my license. And within 2 years, I quit my full-time job and I made that my part-time job. The only reason why I teach 1 day a week is to keep my academic career credentials. It doesn't pay the bill. You may think a professor make a lot of money. No, they do not, right? It sounds good. It sounds nice. It sounds attractive. But when it comes to WFG, that is chicken feed, right? And if I'm going to teach people and educate people and help them make a difference, this is going to make the biggest difference. Because all of my students, if they don't know this information, they're going to graduate with huge student loan. And even the ones who don't graduate with huge student loan, because they don't know this information, when they get that job, they're not going to know how to grow their money. So this is where I'm able to make a bigger impact, right? So again, we're going to launch a poll. And Imara, is there any questions in the chat that we can field?
I saw someone post, one comment that they just lost a young doctor family member with 3 kids and they had no coverage. So 3 young kids, no coverage. You know, like what happens to their home? Where are they going to live? What happens to their school fees? things like that. So that's why we do this, so that these things don't keep happening, right? And it's a doctor, you would think that they would know more or know better. Then someone asked, what happens if I have a life event where, I didn't pass away, I'm still alive, but I'm unable to work. Can the IUL protect me and my future income? And yes, it can. It can. That's the beauty of it, because you can get coverage, income coverage for you, where you can take out this money and it can still keep your lifestyle and your family's lifestyle, and still have a benefit for when you pass away to keep your loved ones covered. So
Guys, 70%, the statistic is 70% of the people who are currently receiving long-term care and living benefit, they're not old people. They're not old people. They're regular people. It doesn't matter age, it's young people, it's middle age, it's anybody, right? And that's the one thing that we see a huge void. We have a lot of doctors in our platform. Dr. Fumble, Dr. Martindale, like all these doctors, they are killing it.
And they got licensed and started doing this and educating their clients in their community as well.
Yep. And when they sit with clients, they don't even really talk about the cash value. All this stuff we just mentioned, that's great. But you know what they talk about mainly? You're gonna get sick. You're gonna get sick. Heart attack, cancer, stroke are the 3 rapid illness that are happening every 7 to 10 seconds. And you're not gonna die, right? But what's gonna happen if you cannot work? How is the mortgage?
Excuse me, I have a question. I just want to ask a question. I work in a nursing home, and when you work in a nursing home, it depends on how long you work, how much money you have. Once you go to that nursing home, everything is turned over to the nursing home. What they normally do, they go 5 years back prior to when you come to that nursing home. So even if you sell that house before you go into the nursing home, you have to turn that money over to them. My question is, if you take out a URL, right?
Well, hey, Miss Charmaine, Miss Martin. Girl, you need to say who you are, okay? I'm like, that voice, I know that voice.
Yes. So if you take out a URL, right, and you have that money, right? Would they have access to it like they have access to everything else? That's my question.
Okay. So you are correct. They do go 5 years back. And guys, we have a powerhouse audience on tonight. Let me see if she's on. We have the lovely Ms. Bunbury, who is an estate planning attorney, who's on. And we have her and I are working on some stuff to have a webinar talking about estate planning in the coming weeks. So that's why you want to make sure you keep coming on these webinars every week, because you just never know who we're going to pull out. So life insurance, right, is never part of an equation. This is why we love it. Guys, O.J. Simpson, I mean, we don't know if he killed his wife or not. Whatever happened, happened. But he was still able to keep some of his money because he had it in insurance products, right? So that is, if you want to get married and you don't know if you're going to have to split everything else, definitely get a policy, because that is one that it's never part of an equation where you're going to have to disclose or split anything, right? When you go to apply for government funding or any aid, you will always see a bank account. They're going to ask for investment accounts. They're going to ask for certain things. How often do you see life insurance? And even if it is, they haven't really caught on to this. So even if they say, do you have life insurance? They're going to think of it in terms of a death policy, right? Something that's going to pay out when you die, right? But again, what we typically recommend is once you put your stuff in a trust, right? And this is where Donna, in a couple of months and a couple of weeks, when we get her on board, ultimately you want to put your stuff in a trust, right? If you really have assets and you're concerned, you want to put your things in a trust. And I know Imara has a trust set up as well. Once you put it in a trust, it is gridlock, right? So they don't have access to it. You don't have to disclose it. I'm doing this right now. One of my clients, we had Holly, our attorney, set her up 2 years ago, and I sat with her. She's really, really big on generational wealth. And I said, listen, we have to lock your stuff up. She just got another baby girl, little Jordan. And she called me and said, hey, Odetta, we need another IUL. And she sent me a copy of her trust, and we're putting the trust. We're making the trust the owner of the IUL. We're putting the trust as a beneficiary to the IUL. So guess what? Everything is locked up, right? Everything is locked up. So there's different strategies, but yes, people who are concerned or you have stuff, for me, everything is locked up. I'm going to get what I'm supposed to get, and everything is locked up, okay? So again, we don't want to overwhelm you, and this is why we're always going to tell you guys, everybody's situation is going to be different. It's going to be unique. This is personal finance. You don't want to put your business out there. Get in touch with a person who invited you so we could have a one-on-one personalized consultation for you based on what your needs are, right? Everybody's situation is going to be different. And
yes, you can put your business in a trust. You
Yeah.
can. If you are an entrepreneur, you can put your business in a trust. I personally have 3 companies, and I've put mine as well as my IULs. And I want to tell, since we just touch on it really quickly, I want to make it known, you don't have to have billions of dollars, millions of dollars to do a trust, okay? Your bank accounts, your regular everyday bank accounts, your 401k policies, your jewelry, your little purses and handbags and whatever you might have, all of that can go in a trust. And the reason for doing that is protecting your assets, your property, so that the courts do not decide what happens, so that your family, your loved ones, whoever you're leaving your stuff to can gain access to it and not have to spend thousands of dollars going through probate court and all these different things. So don't think that having a trust is just for rich people. Everyone should have a trust. Everyone. I just want to say that. Everyone.
Yeah, that's true. That is so true. Thanks for saying it, because there's a big misconception, like you got to have assets to put it in a trust. But right now I'm dealing with one of my clients who passed away. It's been a year. May just made a year, and you know everything is frozen. I mean, she passed away over a year ago, and her two daughters are fighting with each other. They're in probate court because, you know, she did not have a trust set up, and all her assets are at the mercy now of the judge, who's going to decide who gets what in probate court. So to answer your question, Miss Martin, yes, you are correct. They look 5 years back, but this is why we don't know when things are going to happen, right? So we want to make sure that we put things in place. So whenever it does happen, everything is already locked up. Last year, Labor Day, I went to a friend's house, and I was talking to the wife. We were in the kitchen. She's Guyanese, and I was asking her, because she was a nurse, right? She made good money. She was a nurse. Her husband, they had like really great job. And she said to me, something I asked her. Oh, I asked her, how is her retirement income? Because after she told me she was a nurse and she made good money, I said, well, how's your retirement income? You know, how is your income? Like, did you get a Social Security? Did you have a pension? Like, did you have a 401k? And she told me she had all of these things. And because she has all of these things and a house, she's not getting any help from the government because she has all of these things, right? And I said, well, have you ever heard of a trust? You didn't like put things in a trust? And she said, no, I didn't. So she can't apply for any government help because she has money. She has assets. And I know, and you guys also know, that there's people who have money and they're still able to get government funded money. Okay. So again, education is key, knowing this information and putting things into practice. You have nothing to lose and everything to gain, because if you don't have a will and put things in place, well, if you don't put things in place, well, the government is going to put it in place for you, and 9 out of 10 times it's not going to be what we want it to be. Okay,
They're gonna take it away.
right. So guys, thank you so very much. We've come to the end of our webinar. Again, this webinar is recorded. You guys will get an email if you want to watch it back, you want to share it with someone. Please, please, please get in touch. We cannot say this enough. You will always hear us saying this, because we could give you the information, but if you don't implement it, it's going to be a devastation, right? And I don't want nobody calling me in my 60s and say, shoulda, woulda, coulda, listen to you. But now this is what's happening to me, because I am getting those calls already. People in their 60s who probably had a term insurance, and now they realize, oh my God, I can't keep this term anymore, and I'm going to have to let it go. And now I'm like scrambling to get them something. Or they had a really good job, and now they're realizing like this money that's coming in is not enough, so they have to be eating sardine and rice. Right? So guys, please, please, please connect with the person who invited you. Let's schedule a one-on-one so we can help you strategically customize a plan for you, and we'll see you back here next Wednesday for another installment of Money Mastery, because when you know better, you definitely
do better.
Thank you guys. Thank you, Imara. This was great.
Thank you. Everyone have a great night.